Inflation is rising, markets are confused, and once again investors are falling into the same old traps. But what if I told you? Warren Buffett saw this coming 45 years ago. In today's video, I'll share 5 powerful lessons from Buffett's 1980 investor letter. Lessons that can help you protect your wealth and build a compounding machine for 2025 and beyond. Stick around, because what you learn today could change the way you invest forever. After setting the stage, let's dive into Lesson 1, something Buffett called the iceberg principle. Buffett warned that less than half of a company's real earnings appear above the surface. In simple words, the profits you see in financial reports, they're just the tip. The real wealth, the hidden value, lies beneath the surface, in retained earnings that quietly multiply year after year. And here's the key for you. Most retail investors chase dividends. But the smart money, they look for companies where profits are reinvested for exponential growth. Just think about Apple, reinvesting most of its profits, paying minimal dividends, and yet creating massive value. Or look closer to home, Asian Paints and HDFC Bank, silent wealth-building machines. The takeaway? Stop judging companies by how much they pay out. Start judging them by how wisely they use what they keep. Now moving on to Lesson 2, trust retained earnings. Buffett believed that smart reinvestment beats short-term cash flow every time. He didn't need Berkshire Hathaway to get regular dividends because he trusted great managers to multiply capital internally. And what's in it for you? You don't need cash payouts to get rich. You need great businesses reinvesting smarter than you ever could. Just like Geico, Buffett owned 33%, barely got dividends but saw his wealth explode as the business grew. Today, think about TCS and Nestlé India. Low on payout, high on consistent compounding. Remember this: don't invest for cash, invest for compounding. Let great businesses do the heavy lifting. And that brings us naturally to Lesson 3, a killer of silent wealth, inflation. Buffett said it bluntly: you may feel richer, but you won't eat richer. In 1980, inflation was eating away 12% of purchasing power. And today, it might not scream from headlines, but it's silently burning your wallet at the supermarket and at the fuel station. What's the real risk for you? You might see 15% returns in your portfolio, but after 7% inflation and 15% taxes, you could actually be losing money without even realizing it. Here's an example. Invest rupees 10 lakhs, make rupees 1.5 lakh in returns, and inflation plus taxes wipe most of it out. The lesson: always think in real terms, not nominal ones. Choose companies with strong pricing power, like D-Mart, HUL, or Apple, not just flashy growth numbers. Building further, let's talk about Lesson 4, the hidden power of smart buybacks. Buffett loved it when companies bought back their own shares below intrinsic value. Why? Because it quietly increased your ownership without you having to buy more. And here's your edge. Smart buybacks grow your share of future profits automatically. Look at Apple, TCS, or Bajaj Auto, companies that reward shareholders through intelligent buybacks, boosting EPS and overall value. Here's the truth. Buybacks done right are silent compounding machines. Mergers and flashy takeovers, most of the time they're just expensive distractions. And finally, Lesson 5, a brutal but necessary lesson which we touched upon in our previous video. Don't bet on turnarounds. Buffett's famous line still echoes today. When brilliant management tackles a bad business, it's usually the business that wins. Geico was rare because its fundamentals were strong, but for most turnaround stories, they're graveyards for investors' money. What's in it for you? Don't get trapped chasing cheap valuations or recovery fantasies. Just think about Vodafone Idea or Paytm, exciting stories, but broken business models. Instead, stick to companies like Titan, consistent, proven, and economically inevitable. The golden rule? If a business needs a miracle to survive, it's probably not the place for your money. And that brings us full circle. Buffett's 1980 letter wasn't just about past mistakes. It's a manual for surviving today's chaos. If you take away just one thing, let it be this: real wealth comes from businesses with strong economics, smart capital allocation, and the ability to grow without chasing hype. Finally, if this helped you think differently, hit like and subscribe. Next up, we'll break down Buffett's 1981 letter and why debt might be the biggest invisible enemy in 2025. Stay smart, stay invested.